So I got mic'd up so I can run around the stage. And then I realized that this is being live streamed, so there will be gaps in the stream every now and then. Anyway, coming from a central bank, I have to give the disclaimer that the views of what I'm about to present represent my own and nobody else's, and that of my co-author, of course. Both of us are very thankful for being here, and agradecemos mucho la hospitalidad del Banco Central de Chile. Anyway, so the chair did a very nice job for me in terms of setting expectations. So central banking is about setting expectations. Let me make sure that I reduce them instead of doing what he did. What we did in this paper was really, as you can see from the title, try to take stock of what has happened in the past 20 years with inflation, especially because in the middle we have the global financial crisis. And we wanted to understand what, if any, effects did the crisis have on the processes of inflation, and what trends were in motion before the crisis, and what has happened to those trends after the crisis. And we wanted to take stock also across many economies in the world, not just the US, which gets studied quite deeply, as we saw in the previous papers. So all that took us well outside my comfort zone. So this is a paper that describes everything that I don't usually do in my research. So it was a great opportunity for me to learn about all these sort of things. I thought this morning Governor Marcel did a very nice job for our paper, because it really framed the questions that we will be interested in discussing. So let me start by telling you what is it that we do in this paper and what we're after. We're going to think about the financial crisis, which was primarily an advanced world crisis, as an event that should teach us something about the role of credit in thinking about inflation dynamics. And so that's going to be the primary goal of our research. But in addition, we're going to think about what has been going on in inflation globally, and how did the financial crisis affect that process that was put in motion. We have more central banks becoming independent from their governments. We had inflation targeting much more institutionalized. We had a number of developments over the past 20 years that is probably worth thinking about. How does that affect the way we think about inflation dynamics? So the methods we're going to use are relatively simple. We're going to look, as you can see, at a wide cross-section of countries, both developed and developing. We're going to spend not a very long period of time, 20 years at quarterly frequency, but we're going to at least get about 45 economies in our sample. And the experiment, if you want, the treatment that we're going to examine is the global financial crisis. And of course, in this sample of 45 countries, there will be some that went through the crisis, some that did not, some that are advanced, some that are developing. And so we're going to get a very nice mix of sort of treated and control units in the language of the treatment evaluation literature. We're going to think sort of carefully about identification by thinking how to solve that puzzle in two ways. One is to try to come up with some sort of exogenous variation that allows us to identify components in the Phillips curve. But beyond that, we're going to use a technique that's used in applied microeconomics called differences in differences. It basically looks at events before and after some happening, in this case, the global financial crisis, and then you sort countries into whether they actually went through it or not, and you try to sort of tease out what's going on in the economy. What's going on, did we find in our paper? Well, inflation had been declining globally for many years prior to the financial crisis. And in fact, those trends seem to have continued unabated. So, there was a lot of talk during the financial crisis about what had happened to inflation. There was a lot of, in a sense, puzzlement about inflation not having dropped by as much as we thought it would, given the severity of the crisis, and then having taken quite a bit of time to recover. So we'll talk a little bit about that. You could call it a global moderation, perhaps, if you want to coin a new term. Instead of the Great Moderation, maybe the global moderation. The other feature that we find in the data is that, generally speaking, inflation is much more forward-looking, by which I mean that in thinking about the dynamics of inflation, the term associated with the way individuals form expectations about the future seems to carry more weight than it used to in the past. And I take that as a marker of good central banking. And I explain why I take that as a mark of good central banking. But I think the answer should be fairly obvious. So let me go right to it. With those takeaways, why or how does it fit into the question of how should we think about inflation? Well, question number one is, as you saw in the previous presentation in the morning, should we think about inflation as a global phenomenon? Should we think about inflation as driven by commodity prices, oil prices, as reflecting the links that exist in economies through trade? Should it reflect the fact that supply chains are far more extensive nowadays? Should we think about inflation as something that, in a sense, is a little bit outside the control of any one central bank? So that will be one of the running themes as I go forward in the paper. The other question, which caught my eye in a number of discussions this morning as well, was this issue of the flatness of the Phillips curve, this core concept that we use in thinking about inflation in a policy context. And so the pitch that we'll try to make is that some of the commentary that I've heard in relation to the Phillips curve being flat, and therefore this being a reason why we could perhaps stimulate for longer, are perhaps a little bit premature. I will argue that the Phillips curve really is not meant to be a forecasting equation. That is a behavioral equation, and therefore is the tool that we use to think about counterfactual policy outcomes. And when you think about counterfactual policy outcomes, then you have to realize that the Phillips curve may not remain flat if you were to deviate in your policy actions. So I'll come back to this issue, but I'd like you to have it in the back of your mind as I go forward. Okay, so usually you have to pay homage to all the wise people that came before you. And so that's what I'm going to do here very briefly, especially since most of the people I cite here are in the room. So this is very good politics. The first thing to notice with the first reference to Jordi's work is that we should keep in mind that inflation behaves very differently in different countries. So it's a very heterogeneous process. I will talk about averages. It may look like everybody follows a similar pattern, but in fact, bear in mind that there's a fair amount of heterogeneity. And for instance, Jordi shows in his work that inflation dynamics are, for instance, more forward-looking than in the US, in the euro area than in the US. The second reference really is, as I will show you briefly, is for you to think about what has happened in previous financial crises, and did the process of inflation look any different this time around than it has in the past? And the answer will be yes and no, and there are lessons to be learned from that. The third thing that you see there, which is a reference to Fernanda's own work with Carlos, who's also in the room, is that you have to be aware of there's a lot going on in the world, especially in terms of demographic trends. These are demographic transitions that we have never seen in the history of humanity, essentially. We have the advanced world now with declining fertility rates, and the developing world is very close behind. And those are new developments that are, in some cases, leading us to think that the real rate of interest is perhaps lower than we've been thinking about, and that has consequences as to how we think about monetary policy. And it's curious that at this time of demographic transitions, we still, it is the case that inflation is coming down as interest rates are coming down. The final reference also to work by Simon is one that will be quite important for us as we go forward in the analysis. And that is, we will want to think about what's the role of credit in inflation, and what better experiment than the financial crisis when credit was severely constrained for a number of years. So that's going to be a key factor for us. And in Simon's work, if I could paraphrase it, and he will correct me if I'm wrong, one of the theories that was advanced was that if you're a firm and you don't have easy access to credit during a credit crunch, maintaining your liquidity may require you to raise prices at a time where demand is actually soft. That may boost inflation at a time when you would expect it to in fact decline. And so that may lead you to think that the Phillips curve is perhaps asymmetric. If you think that credit bites when it's constrained, but it doesn't bite when it's not constrained. Or it may suggest that the Phillips curve is somewhat flatter when credit is tight. Okay, so let me show you briefly the data. So this is what inflation looks like for the US, the euro area, and Australia. So why those three countries? The US and the euro area, because they went through the financial crisis. Australia did not. Okay, so what you see there is if you have the line, the vertical line describing the financial crisis, inflation had been coming down in all three large economies over the period. The financial crisis obviously had a big impact in inflation in the first year of the crisis, but and subsequently in the euro area especially. But even in a country like Australia, you see that inflation has been coming down for a long time. But it's also true of developing economies. It's also true of what's going on in Asia. It's also true of what's going on in Latin America. And you can see, obviously, there's a big spike at the beginning of the sample with the Asian financial crisis. But in all three groupings of economies, inflation has been coming down quite significantly. And in fact, it's been coming down almost all the way to the level of what is now common to an advanced economy. So that's the one thing to keep in mind as I go forward. There is, of course, quite a bit of business cycle synchronicity, but again, going back to the theme of heterogeneity, you can see in these pictures that there are some differences. So what I display in these pictures is the unemployment rate as my business cycle indicator. And so on the left-hand side, you can see, again, the US, the euro area, and Australia. And there you see very clearly what happened after the financial crisis. So the euro area, of course, had its own sovereign debt crisis, and that had a ripple effect that hit a little bit later and magnified the effect of the crisis in terms of unemployment losses quite significantly. But you can see, as a demonstration of what I was saying earlier, that Australia did not endure the financial crisis. And so as you can see, the unemployment rate did not move by very much. What happened in Asia and Latin America and other economies? Well, even though many of those economies did not experience the financial crisis, their dependency on the advanced world seems to be quite important, and there seems to be a fair amount of synchronicity if you look at what happened to the unemployment rates in many economies. So even though a lot of them escaped the global financial crisis, they nevertheless experienced a little bit of a downturn. Okay, so here's the first piece that I'd like to highlight, and it has to do with what happened to inflation. Did it make sense in historical context, or was this something new? And so what I've done is go back to history and look back 150 years almost, and then ask the question, let me look at all financial crises in 17 advanced economies, and let me see what happened to inflation subsequent to the financial crisis. Then let me compare that to the experience that we saw in 2008. And so the red dashed line that you have on the left-hand side shows you what the path of CPI inflation is in a typical normal recession across all these economies. The dashed and dotted blue line shows the much more dramatic decline in inflation that is typical of previous financial crises. And then the solid line here is US CPI inflation during the financial crisis. And so if you look at that graph, it shows two things. One, it's surprising how little inflation fell. It almost looked like what happens in a normal recession. But then at the tail end, somehow inflation dropped quite significantly in the US relative to what's in a normal recession, but now much more consistent with what you see in a financial crisis. Okay, so that was a little bit of a puzzle in the past 2 years. Now inflation seems to be returning to targeted levels, so it's becoming less of a puzzle. But that was sort of the background to this. The right-hand side picture reinforces some of the statements that Bart made this morning about what happened to output. So whether output has declined in step function form. So what you have here is normalized to 100, a similar experiment to what I did with inflation, but a little differently. So at the start of the financial crisis, think of GDP per capita as being normalized to 100, and then you see what happens over time to GDP per capita following a recession, a normal recession, again shown as a red dashed line. After a financial crisis, shown again as a blue dash and dot line, and then the experience of the US, which is shown as a dark line. And so what's really striking about this picture is that if you look at the red line, output goes down in the first year, and then by year 2, you're back to where you were at the start of the recession, and you keep growing at trend. If you look at the financial crisis, the bottom is usually not in year 1, but in year 2. It's a little bit bigger, and then it takes a long time to go back to trend. But by year 10 of the financial crisis, you're more or less back where you would be if you had just experienced a normal recession. If you look in contrast to what happened in the US, that's really eye-popping. My colleague, Régis Varnichon, calculated the wealth losses from the Great Recession, if they were to remain permanent, to be in the order of $70,000 per citizen. So that's a really significant loss of wealth due to the financial crisis. And this, by the way, is something new, something we don't understand very well. Why is it that the loss is now so permanent relative to what has happened in the past? Okay, now what I'm going to show you to set the stage is maybe do a little bit more of a simple visual of what has happened in terms of correlation. So I could have done a factor analysis, and Mark will tell me all about why I should have used that technique, I'm sure, in the coffee break. But what I did was something much more simple. Just take a window of 10 years, calculate the correlation of some variable with another, and then roll that window forward. And the reason I did that was because it allowed me to control much better what is it that I wanted to correlate with what, not because I think this is a superior technique. So what I did to begin with was to say, what's happened to inflation in the past 20 years? And just look at the average cross-correlation between any two countries. And look at CPI inflation for advanced economies in blue and for developing economies in orange. So what you can see, of course, is that inflation became much more tightly correlated after the financial crisis. But even so, in advanced economies, that correlation is actually reasonably high. Okay? So even now, at the end of the financial crisis, we're thinking of a correlation as about 0.5 on average across economies, which is quite striking because it's a lot lower than what's going on with emerging economies. Okay? If you look at Chile, in a sense, what we did was calculate the correlation of Chile with advanced economies and with emerging economies. And again, so inflation became much more highly correlated than the financial crisis, perhaps because there was a global downturn. But as of late, and much more recently, and perhaps you saw it in the figure that Bart showed, inflation has not really followed the same pattern as all these economies. I think I have the answer for that in the next slide, I think. So, okay, what's going on? Where's that correlation coming from? Part of it has to be found in commodities and oil. And so what I'm going to show you here is what's happened between the correlation of CPI inflation in any one country and oil prices. And as you can see, in advanced economies, that correlation is quite high, even higher than it is in emerging economies. One way to interpret this is that in a world in which the central bank does what it's supposed to do and inflation is a target, then it shouldn't be the case that the central bank is responding to commodity price inflation and oil prices, because those are things outside of its control. And therefore, what you should see over time, I think, is that the correlation of inflation with oil should actually go up, not down. It would go down if the economy can substitute oil for other sources of energy. But if that's not the case, there's no sense in which you would expect that to be linked. And I think that's what this slide shows. In fact, if you look at the right-hand side where I show Chile, you have the correlation of oil prices with CPI inflation for Chile and the US, so you have a reference point. So for the US, look at that, it's almost 75%, and that really connects well with what Bart was showing us earlier. So in the US, in fact, the correlation is much higher than it is for the average of advanced economies. For Chile, is a lot lower, in some cases, somewhat negative. But there's more to the story for Chile, of course. And that comes from commodity prices, perhaps. In Chile's case, of course, Chile is a big exporter of copper. So what I did was ask the question, well, what's going on with correlation of inflation with commodity prices? In the advanced world, in emerging economies, it's not nearly as significant as it was with oil prices. So oil still is the king in some ways. If you look at copper, I just show you what's going on between copper prices and US inflation, and Chile and copper inflation. Of course, Chile is the red line on the bottom. Chile being an exporter, that's kind of good news for them, all right? For the US, higher copper prices are highly correlated with domestic inflation. Again, if the central bank is only responding to domestic considerations, then that's exactly what you would expect to happen. And then just to finish up with this set of graphs, where I showed just correlation, this is just showing you what's happening to the cross-correlation of unemployment rates across economies. On the left-hand side, again, you have advanced economies and emerging economies. And you can see, of course, the correlation went up during the financial crisis. It was a global event, especially in the advanced world. Somewhat different to what goes on in Chile. I think Chile, perhaps because of copper, you have a different synchronicity with the global business cycle. Okay, so that's the stage. So now I'm going to dive into the specifics of what we do. The first thing that I'd like to reflect upon is when we have a Phillips curve, why is it that it's not perhaps a good idea to think about it as a forecasting model? And so here I'm going to borrow from Gali's own work to explain what I have in mind. So this is as simple a Phillips curve as I could imagine that expresses inflation as a function of, let's say, the output gap, but you can imagine any other variable associated with aggregate demand fluctuations in there. I've removed the expectation term for inflation, just for simplicity. And so I'm going to think about a policymaker that wants to minimize inflation fluctuations and perhaps minimize fluctuations in the output gap with some weight. And it has a quadratic loss, as simple as we can make it. The resulting targeting rule from that setup is the one at the bottom that basically expresses inflation as depending negatively on the output gap. And I've added a little term at the back end of that equation in red that basically says there might be some sort of implementation mistake by the central bank. Okay? You can call it many things. Maybe you didn't read the expectations properly in a more complicated model, but that's the setup. So if you were to plot this in a supply and demand type fashion, what would you see? Well, you have on one hand the central bank trying to set up policy to offset these deviations of output from the output gap, from the potential output. And then on the other hand, you have the Phillips curve relationship that tells you what happens to inflation when output deviates from potential. And so the Phillips curve would be the curves displayed in blue, and this policy reaction function would be the curves displayed in red. And so what you would see in the data would be a cloud of points like you see in a supply and demand graph. So you have a simultaneity problem that would not allow you to really tease out what the slope of the Phillips curve is unless you have a source of variation, basically, in this case, what the central bank is doing. So the horizontal line that I have there is just the classic simultaneity example of supply and demand. What you'd like to tease out, in my case, would be the dark blue line, for which you need just variation in the central bank. That's the approach that we're going to use to try to tease out what the Phillips curve is. What we're going to do is reflect on the following fact. from economics or international economics. So the trilemma of international finance says the following. If you're pegging your exchange rate and you have free movement of capital, then in a sense you lose control over interest rates. And the reason is because agents in the economy can arbitrage the returns across economies. So if I raise interest rates, then what's going to happen is that you're going to borrow from outside to invest inside, and that's going to move the interest rate down. And again, if you're offering interest rates that are too low, you're going to have the reverse arbitrage proposition. And that's an arbitrage proposition because in principle, you have no risk. The exchange rate is fixed, so all that risk is to a great extent ameliorated. So if you take the euro area as an example of a currency union, and you think about what was going on in the lead up to the financial crisis, this graph, I think, displays very nicely what I'm trying to explain here with the trilemma. You have the target rate that the European Central Bank had up to that point in a dashed line. And then you have in solid green the Taylor rule that would be consistent with countries in the core of the euro area. And then in red, you would have what the Taylor rule would predict interest rates should be if you were a country in the periphery. And of course, if you were in the periphery, interest rates were too low for you. And if you were in the core area, the interest rates were pretty much what they ought to have been. So it's perhaps not surprising what happened in the periphery of the euro area once the crisis broke. But the point that I'm trying to make here is different. The point that I'm trying to make here is that because we have this arbitrage condition, then countries in the periphery essentially experience an exogenous source of variation in interest rates. They were higher than they would have been had they had their own central bank. And that source of variation is useful for identifying the Phillips curve. The expression we're going to use in our analysis is given by the top equation there, and basically expresses CPI inflation as a function of a constant term that varies by country. It allows a term that basically looks at what inflation was in the previous period. And then it has a forward-looking term that basically sets inflation depending on what your expectations about future inflation are. You have a term beta based on what the output gap is. And then in the term W, I collect prices of commodities because those are considered as a little bit outside the system. So I do kind of take consideration separately for those prices. So the idea would be to estimate this curve, this expression, and then to use instrumental variables to estimate that expression. And then the way we're going to do it is for economies that peg their exchange rate, we're going to use essentially base country interest rates. In our case, the US, for economies that peg to the US, and Germany for countries that are in the euro area. Okay, so if you do that, here's sort of what you get. So before the crisis and after the crisis for all countries on average. So the Phillips curve would have a backward-looking term that's about 0.66, and it's about 0.34 on the forward-looking term. And those are allowed to vary freely, so they're not constrained to sum up to 1. It just so happens that they do sum up to 1. And then the slope of the Phillips curve is relatively flat, it's 0.03. And what happened after the crisis? Actually, not a whole lot if you think about it. The backward-looking term diminishes a little bit from 0.66 to 0.5. The forward-looking term goes up quite a bit from 0.35 to 0.8. And the Phillips curve slope remains pretty much the same. Now, what about, say, a country like Chile? We saw in the previous slides when we had the comparison with Chile and other economies what was going on. Did Chile experience a similar thing? Well, the Phillips curve actually doesn't look too different if you look before the crisis. I use the unemployment gap instead of the output gap because it's more convenient in this case. The number is actually strikingly similar in terms of the loading on the backward-looking term and the forward-looking term. After the crisis, actually nothing much changed except perhaps the slope of the Phillips curve became a little bit steeper. So in the case of Chile, which pretty much sets aside from what happened in the US and Europe, you can see that the curve hasn't changed that much. And we'll come back to this when I talk about other countries, because I want to disassemble for you what we found in the data. Okay, well, this is all great, but there's a fair amount of things that were in train before the crisis. And so perhaps it wasn't so surprising that after the crisis, all we were doing is just following those trends. More central banks were becoming independent, the loading on expectations was becoming larger. That was already in train before the crisis. So let's look into identifying really what were the effects of the crisis. And to do that, here's what my diff and diff strategy looks like. So that equation looks complicated, but it's not. All it does is say, estimate the Phillips curve before the crisis for countries that eventually experienced the crisis versus countries that did not. And then look at after. So if the trends are the same in both countries, then any differences between crisis hit and those countries that avoided the crisis ought to be a measure of the impact of the crisis on inflation dynamics. That's the idea, okay? So in our case, the last bit of that Phillips curve is really what's measuring the marginal effect of the crisis net of all these trends that I've been describing. So here's what it looks in a picture that you'll see repeated momentarily. But if you want to think about it as a picture, you have the before and after. And so what I've plotted here is the coefficient on the backward-looking term of the Phillips curve. Remember, crisis-hit economies are usually advanced economies. No crisis-hit economies are usually emerging economies. So the backward-looking term loads more heavily for emerging economies than it does for advanced economies before the crisis. And then if you look at no crisis-hit economies, as time goes by, and I look at after the crisis, you have a fairly substantial decline on the backwards-looking term. It goes from 1 to 0.6. That's pretty dramatic. What happened to crisis-hit economies? Well, they do decline, but not nearly as dramatically. And if you had assumed that crisis-hit economies would have followed the same trends as other non-crisis-hit economies, then you would have expected to see that thing called crisis counterfactual. And so the difference between the 2 points in orange, that ought to give you a measure of how big the effect of the credit crunch, the financial crisis, was in the crisis-hit economies. So that's what we're going to measure. This table is meant to test your optical acuity. It's not meant to convey anything economic. But it's meant to tell you that difference in difference approach really gives you a lot of information. You can parse out for all the coefficients in the equations of the Phillips curve equation. It allows you to parse out what happens to the backward-looking term, to the forward-looking term, to the Phillips curve slope, what happened to crisis-hit economies, non-crisis-hit economies before and after. So there's a lot of information in the table. I'm not going to go through it. Here's how I'm going to go through it. I'm going to do it with pictures. Basically, this is the same picture on the left-hand side that I showed you earlier. It tells you what's the loading on the backwards-looking term. The right-hand side tells you what happened to the expectations parameter. Very clear. As time was going by, less loading on backwards-looking terms, more loading on inflation expectations, both in crisis-hit and non-crisis-hit economies, but with a big difference. And the big difference is that crisis-hit economies did not experience nearly a reduction in the backwards-looking term as non-crisis-hit economies. And mirroring that, that's what didn't happen in the expectations term, in the forward-looking term for crisis-hit economies. So non-crisis-hit economies saw a much bigger loading on the expectations term than it did in the crisis-hit economies. Now, there's enough variation in the data that I cannot get this tightly with stars in the table. But economically speaking, that change in terms of magnitudes is actually relatively big. So it's more in precision than economic importance. Economically important, I think that's a big deal. Now, was there a difference between advanced economies and non-advanced economies? Well, yes, actually. So all those differences that I showed you had nothing to do with what was going on in the advanced world. In the advanced world, actually, the effect of the crisis was very tiny. The trends that were in motion before the crisis pretty much remain almost unchanged after the crisis. It's true for the backwards-looking term, and it's true for the forwards-looking term. that treatment effect, the difference between the counterfactual and the actual outcome, is relatively small. What I did here is basically just focus on just advanced economies. And in the next slide, what I did is say, okay, there were some crisis-hit economies that were in the emerging market basket. So what happened there? There, the evidence is much more dramatic. So if you're an emerging economy and you're on your way of having the loading on backward-looking term decline rapidly, the crisis basically put a stop to that. Okay, so the credit crunch was felt much more significantly, I think, in the Phillips curve of these emerging economies. Okay, so right on cue, I have a minute to sell you on this. My view is that inflation has been coming down globally, is becoming much more forward-looking, and I would call that better anchoring and consistent with better central banking. It's unclear what the effects of the credit crunch were, although I think some of the evidence that we present is consistent with, at least for emerging economies, those effects having been important, less so for advanced economies. To my eye, that's supportive of the hypotheses and the good work that Simon and his co-authors did, but we don't have that nice conclusive statistical evidence. And there is evidence, I think, though, that the effects of the crisis seem to be dissipating quite rapidly. So this may be a return to the trends that we're observing before the crisis. However, output losses are still quite large, so more to be said. I have one less than zero left, but I think I want to touch on a couple of policy questions right there at the bottom, especially the one that talks about the Phillips curve not being a good forecasting tool and really being a tool for policy. If you buy what I just explained about the decline of the backwards-looking term and the increase in the forwards-looking term, does the flatness of the Phillips curve bother me? And the answer is no, because that's exactly what you would expect if the central bank is doing its job. It would be completely counteracting what's going on the demand side of the economy to the extent that all you would see is a flat rate of inflation at 2%. And so to my eye, the more correlated inflation is with oil and commodity prices and the flatter the Phillips curve is and the higher the loading on expectations is, then it's all symptomatic of policy being conducted as it should. And so to assume that because we have a Phillips curve, we can never, therefore, stimulate the economy, it would be a mistake in my eye. Because that would be basically breaking down that formation of expectations that we've been seeing in the past 20 years, and we'll be returning us to a more backward-looking, more steeper Phillips curve world that could potentially let inflation let loose. So I'll leave it at there.